Hello.
Yeah, Gaurav.
Yeah, Ashish, in 5 seconds you can start.
Okay, 5 seconds we'll start, right?
Yeah. Nilesh Shah also can unmute the video.
Nilesh bhai will go live in 10 seconds.
Yeah. I will keep it muted because कभी-कभी थोड़ा background noise आता है. जैसे तो question करेगा, I will move to.
Okay. Gaurav, give us the cue, huh? Give me the cue when to start.
Yeah, you can start now.
Yeah. Hi everyone, I am Ashish Shanker, Head Investments Wealth Management at Motilal Oswal. I'm very excited to bring to you episode 1 of season 2 of Know Your Investment Guru. This is an extension of Know Your 4C Fund Manager series. Today, I have with me a very, very distinguished guest, someone I have personally known for more than 2.5 decades, and I have learned tremendously from his wisdom. He is a gold medalist chartered accountant. He's been in the industry for over 2.5 decades. He's currently the MD and CEO of Kotak Asset Management. He dons many hats. He's on the Economic Advisory Council of our Prime Minister, and he's also the AMFI chairman. Somebody who's seen many cycles and has a fantastic insight into the world of investments, capital markets. So I'm really, really excited to have this conversation with him today. So welcome to the show, Nilesh bhai.
Thank you, Ashish. It's my pleasure to be part of this show.
Right. Nilesh bhai, I know that you have a very nice framework of analyzing what's happening around the world. Today, the biggest problem that investors or our clients are also grappling with is multiple variables which are at play. I mean, we got hit by this pandemic sometime in February, March. Of course, markets tanked and there was widespread panic. Post that, we've seen a lot of the Western governments, as well as in India, reacting very, very quickly to this crisis. I mean, there is a lot of money which has been put into markets from the fiscal side as well as from the monetary side. Globally, markets are almost close to their all-time high. I'm especially referring to the US. So really, this last 2-3 months has been very, very puzzling for investors as at large. And a lot of what is happening is not from a classic playbook. I mean, even when I go back to history, what I've read or whatever I've experienced, a lot of it doesn't seem to be from a classic playbook. So really would like to know your framework of looking at things around the world and how does it impact India?
So Ashish, as they say, history repeats itself and wise man learns from the history. There's a fantastic book called Lords of Finance, which talks about central bankers of Great Depression era. And one conclusion is that they converted depression into Great Depression by not taking appropriate action at the right time and by withdrawing stimuluses at the wrong time. I think every central banker in the world has learned this from this book, and they want to ensure that they don't become the cause for the immediate recession. The textbook is now that if there is crisis in economy, pump liquidity, cut interest rates, ensure that there is limited pain, survive the short term, will figure out what to do in the long term. I will call this, in what was our childhood favorite serial Star Trek, to boldly do what no other man has done before. So Bank of Japan is the leader in this fact. In 91, when Japan hit recession, they cut interest rates to zero, they pumped liquidity, where now their internal debt to GDP ratio is more than 250%. They have become largest investor in ETFs on Japanese companies, and they are now the largest owner of Japanese equity across the world. Clearly, all over the world, we are seeing this Bank of Japan movement where ECB, US Fed, Bank of England, all are talking about extremely low interest rates, extremely high liquidity, refinancing windows, essentially ensuring that there is no short-term pain to the extent possible. If you see globally, the GDP forecast is likely to be down by about $12 trillion from $85 trillion to $73 trillion. And the economic stimulus announced by various countries around the world, and it is still being announced, is already upwards of $20 trillion. So as Stanley Druckenmiller put, never underestimate the power of US Fed. It can lift any asset prices. And we are seeing this in various formats.
I think he had famously coined that term Fed put, right?
Yes. The same guy, after coining Fed put, went wrong in predicting what Fed will do in 2020. And he raised his hands and said that, look, I underestimated the power. I think this power of money is also visible in segments like automobile, where Tesla with $26 billion sales is the most valuable automotive company. And it's more than the combined value of GM, Ford, Ferrari, Toyota, whose combined sales is more than $700 billion. So there is on one side extremely high liquidity, extremely low interest rates, which can inflate any asset value irrespective of what the fundamental might be.
Right, right. Nilesh, I just wanted to dwell a little more on the point that you made, Laws of Finance, the book which was written on the Great Depression, because a lot of comparisons are being made between the current period and the period of depression in the US. In fact, Buffett himself referred to it in his AGM, in his speech, annual speech. Point out to everyone that at that time, US was linked to the gold standard. The currency was linked to the gold standard, and hence they didn't do stimulus quick enough, like you said. And secondly, about 6,000 odd banks failed at that time. Whereas this time, remarkably, I mean, even during the global financial crisis, Fed put a lot of money in the banking system to ensure that a lot of banks survive. I mean, after the failure that we saw. And this time around, in fact, Fed has gone one step further, where they've not just put money in the banking system, they've actually put money in the hands of people. Now, I just wanted to know the difference between the Great Depression and now, and what are the medium-term implications? Because a lot of comparisons are being made, to be very honest. When I read the history, they are different to quite an extent.
So when Great Depression came, again, my memories are from reading books and reading research papers, no direct experience. I think there the central bankers were not having unlimited ability to print money. The political class was willing to give short-term pain for long-term gain. They were in the 90s or 97's IMF recommendation to India and Southeast Asia. If you remember, when we went through crisis in 91 and Southeast Asia in 97, we were told, bring your fiscal house in order, cut government expenditure, divest and raise resources, raise interest rates so that you can attract foreign capital, open your economy for foreign investment. Essentially, all their strategies were for our long-term improvement. They pushed us to lower import duty on thousands of products so that our manufacturing can become competitive. Now, in the process, there was immense short-term pain. Interest rates went up, protection came down, government expenditure came down, tax revenue went up, tax burden went up. But this is like, putting a person to exercise when he's suffering from cholesterol, blood pressure, diabetes. There was short-term pain, but long-term gain. On the other hand, in 2008 subprime crisis or 2013 PIGS crisis of Portugal, Italy, Greece, Spain, the approach was totally different. They focused on short-term gain rather than long-term pain. Their whole approach was to lower interest rates to zero, give as much government spending as needed, increase fiscal spending beyond limits, monetize deficit by involving central bank's balance sheet. Pre-crisis, US Fed balance sheet was $1 trillion. Post-crisis, it became $4.5 trillion. They pumped $3.5 trillion into US economy. ECB came saying that whatever it takes, we will do. So somewhere the world has shifted from short-term pain, long-term gain to short-term gain, long-term pain kind of scenario. And as I mentioned, Bank of Japan is the leader to boldly do what no central banker has done before. So we never know, we don't know how this will end, but might as well enjoy the music while the play is going on.
Just to extend that thought, Nilesh bhai, what could be the medium-term implications of this strategy of short-term gain? I don't know whether there'll be long-term or medium-term pain, but what could be the possible implications, and what should investors be wary of?
So I think Japan is a classical example where, despite high liquidity, low interest rates, and bold approach of the Bank of Japan, the GDP growth is declining. So one thing is quite visible to everyone in the world, that if you are not open to migration, if you're not willing to accept best of the brains from outside your country, you will stagnate. Right. Somewhere when the focus is on foreign direct investment, where capital surplus country bring their capital into capital deficit country, we will migrate towards foreign direct labor, where labor surplus countries like India, China, Sri Lanka, Bangladesh, Pakistan will send surplus labor to these developed countries despite their cultural issues and so on and so forth. The entire growth of Middle East is based on migrant labor. In many developed worlds, migrant labor, apart from migrant intellectuals, will add value to their GDP. And if you don't accept migrant labor like migrant intellectuals, you will probably go towards stagnation like Japan. The second thing, growth will become a premium. There are countries like Japan which are stagnating for a variety of reasons, apart from what I mentioned earlier in terms of acceptance of migration. But clearly, there will be countries like India, China, which will continue to grow as their per capita GDP is significantly lower than global averages. The capital will shift towards these countries where growth opportunity is higher, and mixture of global capital along with rule of law in those respective countries can create a cycle of growth. There will be shift of capital from developed worlds to developing world, and there will be shift of labor from developing worlds to developed worlds, and that will create a global integration, a better growth, and probably more equitable growth in the days to come.
No, great, Nilesh bhai. Just to sum up for our viewers, I think it's very important to differentiate the Japanese example and probably the US one. Like Nilesh bhai said, that you can pump in a lot of money, but in the long run, GDP growth is a function of population and productivity. When I say population, it's the working class population. So I think he beautifully explained the reason why Japan has stagnated, because they didn't allow migration and the working age population has reduced. So in spite of all that stimulus, Japan has really faced a challenge of growth, whereas US has still grown in spite of a lot of stimulus they put. In the future, we'll see how it works out. But I think one of the big advantages of US is they have continued to allow migration, and intellectual capital has continued. So in the same light, it is quite possible that China and India continue to grow, because at least when it comes to, we have a very large working population, and some of the policy measures, reforms can really accelerate productivity. I mean, that's the hope. If it accelerates productivity, then India and China can grow. And if India and China grows, like Nilesh bhai said, that growth will be at a premium. So there is a possibility that large pools of capital which have been infused, there is a possibility those pools of capital could continue chasing countries like India and China if people see reliable growth in the future. Nilesh bhai, coming to home, right? Given this context and framework, which you very beautifully explained, what are the implications for India? Because here, what we have chosen, we really use the central bank's balance sheet very aggressively to pump liquidity into markets. However, on the fiscal side, government has not done that much directly in terms of stimulus. Of course, they've done a lot of other things like guarantee loans and things, indirect stimulus, but direct stimulus is low. So, how do you see things evolving in India?
So in the Indian context, when we announced our economic package, lockdown was continuing and supply side was restricted. If we would have given fiscal stimulus then, the demand would have gone up, but supply would have been choked and inflation would have come into play. It's far better to give fiscal stimulus when your supply side is unchoked and inflation will not become a threat. So my guess is that fiscal stimulus will eventually come in tranches when supply side is completely open as we speak right now. Second, at the end of the day, RBI and government is like Sachin Tendulkar and Saurav Ganguly or Rohit Sharma and Shikhar Dhawan. Both of them are capable of explosive betting. But if one is on fire, the other person has to hold the other end. Now, we are one of the few countries in the world which have ability to fire multiple bullets. RBI has cut interest rates to lifetime low level on policy side, repo at 4%. But they still have room to cut 400 basis point on repo. No other country in the world is capable of cutting interest rate at that level. Now, government's fiscal deficit to GDP ratio is upwards of 5-6% this year, but our debt to GDP ratio is still 70% without taking into account parallel economy. We can easily raise another 10-15% debt to GDP to fund our growth if there is a need. Third, Government of India sits on many dead assets which it can monetize. For example, since 1965, we have custodian of enemy property, where 9,000 real estates of people who migrated to Pakistan pre-independence are lying unutilized. They are being encroached upon. Why not clean it up and sell it and raise resources? We can also follow Margaret Thatcher model, where when she became Prime Minister of United Kingdom, she started cutting down government assets like parks, palaces, big offices, big bungalows for their ICS, their administrative services, and so on and so forth. There is possibility to cut government assets significantly to raise resources to fund expenditure. More importantly, India is one of the few countries where there is dead asset lying in individuals' accounts. No one knows how much gold India owns. It could be anywhere between 2 trillion to 3 trillion. Now, what if we bring an amnesty scheme where we say you disclose your Tijoriwala gold into bank account, and at 25 or 30% tax, it gets part of white economy. Even if 10% of gold moves from Tijori to bank account, that's probably $200 billion move. And at 30% tax rate, that's $60 billion revenue. So we have ability to fire fiscally, monetarily, and through monetization of dead assets to raise resources to fund investment to create GDP growth. And in all these things, there's one more opportunity coming to India, which we missed out sadly in 1980. 1980, India and China were of similar size. China became manufacturer to the world. हम लोग पीछे रह गए. They are now 5 times bigger than us. What we did with becoming back office to the world through India's IT and BPO industry, we need to now replicate on the manufacturing side. Companies wants to move out of China. There is severe competition from Thailand and Korea to Bangladesh to Mexico. But all those countries put together does not have 136 crore consumer market which India has. So there will be natural interest of people to come into a large market like India. Second, we have democracy. Many of our competitors does not have democracy like India. Third, the goodwill of India has gone up in the world now. As China exported Wuhan virus to the world, we exported hydroxychloroquine tablet. Put all these things together, can we replace red tape with red carpet? Can we bring companies out of China to India? If we are successful, we will create another level of growth. So there are lots of silver lining in the dark clouds. And if we can play our card well, using fiscal stimulus, monetization of debt assets, attracting foreign direct investment, and also on a reciprocal basis, getting their labor market opening up and shifting some of our labor, we create another stream of remittances. Put all these things together, India has a golden opportunity in this dark clouds.
Very nicely put, Nilesh bhai. Just a follow-up question on that. This entire manufacturing opportunity has been available to us for some time now. But just to borrow from someone's quote, we are a very noisy democracy, right? So you are on a lot of these policy panels. Practically on the ground, are there any steps you think we can take to accelerate this process? Because I think a lot of the solutions are known, and many people have also voiced their opinions. But somewhere, we get caught up in this entire conundrum of debates. And like I said, we are a very noisy democracy. On the ground, are there any practical steps that, all of us can take? I'm saying that, look, it's very easy to put blame on the government or any other counterparty. But I really look at it, this way, that we are all part of the ecosystem, right? Are there any practical steps that you think we can take towards this?
So one, Ashish, India, whatever you say, opposite is always true.
Yeah.
So if there is someone saying that India is a very bad country, I can give you 1,000 examples to prove why it is a good country. If someone says why India is a great country, I can give 1,000 examples to say why India is a bad country. We are not a homogeneous society. Our smallest state, Goa, has population equivalent to Estonia. Our biggest state, UP, has population equivalent to Brazil. There may be just 10 countries ahead of UP in terms of population. Our richest state, Delhi, is as rich as Indonesia. Our poorest state, UP, is poorer than Nepal. We are not a country, we are a continent. So when you are evaluating India, if you say there is homogeneity, it is impossible. We are the living example of a chaos working or anarchy which is functioning. Now let me give you some positives. Vestas, a German turbine maker, wind turbine maker, came to India from China, and they said, we set up our factory in China in 18 months. In India, they could set up their factory in 15 months. Wow. Now, how many Indians will be aware of this? We have an ecosystem which will highlight, oh, yesterday 22,000 people got infected with COVID-19. But they will not highlight that yesterday 20,000 people recovered from COVID-19. Net addition is 2,000 people on 136 crore people. We are interested in self-denigrating ourselves. When our people go and write in international forum, they are more than happy to project our negativity rather than our positivity. We are not a perfect country by any means. We have our limitations, we have our challenges, but everything is not bad.
Right. No, you're right.
The way we provided Vestas execution capability, it's a fantastic thing. Our media went gaga over Elon Musk setting up their Tesla factory in 12 months in China. Did we hear similar noise when Tata Motors started rolling out Nano in 18 months from Sanand about 10 years back? No. So somewhere we need to get back into a mindset where we start doing more of right things and less of wrong things. I don't think so we can ever reach a state where we will do everything right. We have to accept success with failure.
No, you're absolutely right, Nilesh. I think we can do with every bit of positivity at this point in time, given the circumstances. I think that was a very enriching overview of the macros in India. And I just want to summarize what you said, Nilesh, because you explained it very beautifully. I think the first part where you mentioned that the stimulus need not be treated as a one-time activity. This is a challenge that we are going to muddle through over the next few months. So you rightly said that as one batsman is pinch hitting, the other guy needs to take singles. So on one side, the central bank has obviously done a lot. On the fiscal side, we are doing it gradually. And like you rightly said, you also need to ensure the supply side bottlenecks are solved. It is not enough by just stimulating demand. I think the second point you made was also very, very relevant, that though the fiscal deficit in India, the combined fiscal deficit may be high, our balance sheet is still very good. I mean, compared to a lot of the European countries, if I look at the combined debt to balance sheet ratios of 70%, I think we are one of the best. So there is significant place to garner resources on the balance sheet front. And then you also mentioned that there are so many assets that the government can unlock, right? So resource raising is not a constraint at all, and it's just the pace at which you do it. How do you moderate it? Because this is a complete unknown. We don't know how long this will last. So I think a measured approach is what the government has taken, and time will tell how this works out. But I think you explained it beautifully in those three parts. And you answered my follow-up question as well, which I was going to ask you, that what is stopping us from going back to high growth rate? And you explained beautifully that there are a lot of opportunities in front of us. Obviously, given the noisiness of our country and the like you said, that we are a perfect example of a nation working systematic manner through chaos, right? And I'm sure we will thrust with the kind of positivity that you brought in. So thanks a lot for that. With this, Nilesh, I just wanted to know your views on asset classes. I mean, given this macro backdrop and whatever is happening around the world and in India, on equities, fixed income, gold, I mean, we've discussed it multiple times, at our investment committee forums. But really now, if an investor were to construct a portfolio or look at his portfolio, what would be your asset class framework?
So Ashish, before I want to go to asset class, I just also want to put a constraint which India faces.
Right.
See, we all believe in fairness, but life is completely full of unfairness. In 2009, Greece was rated higher than India, despite having shaky macroeconomic fundamentals. We do face challenges in this world where white skin gets higher value compared to brown skin, even though blood is red. Now, we have to navigate within these constraints, and which is where many times we are not able to do what others are doing. Someone might get away with a hook shot, but in India's case, if we try to hook, they will probably announce it out, even if the fielder doesn't catches it.
Right.
So rules are different for developed nations and developing nations, and we have to live within those constraints. Right. With that, when we come to asset classes, my one-line assessment is that this is time to be marginally overweight equity. On a P ratio basis, every single stock is highly expensive because earnings have disappeared. But on a market cap to GDP ratio against historical average of 75%, current market cap to GDP ratio is roughly about 70%. That's by and large, marginally overweight equity position. On gold, I will say again, overweight position. It has moved from 1450 to 1800. It may go down a little bit up and down, but over a longer period of time, gold should deliver better return in extremely high liquidity and extremely low interest rate environment.
Right.
On offshore assets, my recommendation will be overweight, primarily to get exposure in those businesses which don't exist in India. On real estate, my recommendation is to remain underweight on commercial real estate, but be bargain hunter in residential real estate, which will be available at bargain prices and hence can give you higher rental yield. The rents are not going to go up. Prices have to come down to get your rental yield.
Right.
And, karma comes back. For decades, real estate developers have taken consumer for a ride. Now it is time for consumers to take these real estate developers for a ride. On the fixed income side, credit space is looking attractive. but this is meant only for those guys who can take one or two knockdowns in terms of delays and defaults. If you are not willing to take risk on the fixed income side in credit space, then better to be invested on duration side. Falling interest rates globally will also bring down interest rates locally, and duration also will be able to give return apart from coupon income, albeit with volatility. So in summary, marginal overweight equity at this point of time, overweight gold, overweight offshore assets, underweight real estate, and if your risk profile permits, be overweight credit, otherwise be overweight duration.
Right. Just to explore a little more, Nilesh, because there has been a lot of chatter around this. I mean, we saw a few defaults over the last couple of years, and the credit space in the mutual fund industry has been hit by quite a few challenges in the recent past, and we saw 6 schemes being frozen in one of the AMCs. Of course, since then, things have improved quite a bit. I mean, liquidity has gone up, and I also see in the market that with AAA now, even the AA companies are beginning to get money, and it's becoming easier. So, and the other thing, I think you have constantly been messaging that the total risk in the mutual fund portfolios. I mean, if I take the entire mutual fund debt AUM as a basket, the exposure to AA or below names has dramatically shrunk. So if you could just throw some light on this, because investors are really worried after their recent experience, and if you could share a few points as to how
Sure.
it changed.
So one, Ashish, I would like to highlight that delay or a default does not mean total loss. In our own case, we had delay from SL Group in 6 of our FMPs. We had to take a decision whether we sell SL Group papers at throwaway price and pay back our investors, or work with them to recover full price and pay back our investors with a delay. In about 6 months, we were able to recover everything and pay to our investors. There were many WhatsApp warriors and social media gurus who were pushing us to sell the paper and cause loss for our investors. Right. We decided to ignore them, and fortunately, we have been proven right. It was a matter of really satisfaction that when we went to meet half of our investors to explain our decision, they simply said that, Nilesh bhai, we have confidence in you. Whatever decision you are taking will be right for us. You don't have to approach us. Half the investors were obviously worried, but once we explained them the logic, they were with us. Today, all my investors are comfortable with the decision which we have taken. On the other hand, all those social media gurus and WhatsApp warriors, which were advising us to sell our papers at throwaway prices, have now moved on to become China experts. The same tendency got repeated in April when Templeton announced finding of 6 schemes. They went overdrive to tell investors to be aware of credit risk in mutual fund portfolio. They created myth that investors are redeeming from debt fund, and person who will be left behind will be holding the crying baby. Today, they are not apologizing to these investors that in the month of May, the same credit risk fund delivered 24 to 36% annualized return or 2 to 3% absolute return as credit spread came down. Bearing Templeton, everyone else continued their operation as usual, even though we were hit with unexpected reductions. And more importantly, people who looked at our portfolios were comfortable staying invested. So my recommendation to investor is that please don't listen to WhatsApp warriors and social media gurus. They have nothing to lose when you lose money. Please listen to your trusted financial advisor who will be interested in protecting you through the volatility. He will give you right advice. Second, please look at the portfolios before taking any decision. In WhatsApp, lots of wrong messages get circulated. Lots of hearsay gets converted into fundamental research. So please be careful about what you hear in social media. Do your own research or take advice from your trusted financial advisor who will be interested in protecting your interest. In the debt fund today, we have seen flows coming in April, May, as well as June, collectively of more than 1,50,000 crore. This is despite so-called experts and media going against debt funds and spreading all kinds of rumor. In fact, if I look at my debt funds return over 3-year period, and Ashish Bhai, I calculated this return at the peak of the crisis on 21st of May. The returns averaged between 7.55% to 9.54%. And in my credit risk fund, despite taking knock on ILFS, Divan and Yes Bank, it is 7% return. Daily liquidity with this kind of return on a 3-year basis is reasonably good performance. And investors who stayed invested through the volatility have generated this return. So my recommendation to debt investors will be trust your advisor. Don't focus on what social media is saying. Those guys have nothing to lose in giving loose comments.
Absolutely. Oh, well put, Nilesh Bhai. In fact, just wanted to reiterate that generally, even we've seen, Nilesh Bhai, amongst our clients, people who have mutual fund portfolios and they've managed risk properly, it's diversified between AAA, AA, single A, they have been far better off than people who directly gone and invested. Even a credit fund, which has had some accidents, has actually come out better than clients who gone and directly invested in papers. Because I know a lot of clients who invested large amounts in certain direct papers, which are actually defaulted. So like you said, bad news travels much faster than good news everywhere. And it's time for the industry to start highlighting good news. I mean, apart from the SL example, which you gave, I know a couple of other AMCs also who had certain papers which have got upgraded. In the Franklin schemes, that there is a lot of money which has come back and sitting as cash and will get paid out once this court case clears out. So broadly, I think if you stick with your asset allocation, your diversification, I believe, and I've seen it in client portfolios, that this is a far better way to participate in asset classes. Thank you, Nilesh Bhai, for that. Moving on, from the time you've joined Kotak over the last 5-6 years, the journey has been fantastic. I mean, you manage close to 2 lakh crores of AUM, and I know that you have helped define a very clear framework or investment philosophy across fixed income, equity, and other products. So if you could just give us an overview as to how things are run in Kotak and what is the broad philosophy and framework across teams.
So Ashish, I mean, undoubtedly we have seen great growth in last 5 years, but to give credit to me will not be appropriate. If you notice my entire investment team, they have remained the same. Harsha, Harish, Pankaj, Lakshmi, Deepak, Abhishek, they were all there before I joined, and they are doing good work then, they are doing good work now. What I have done in Kotak Mutual Fund is to ensure that the burden of performance is taken away from fund managers. Fund managers are not God, they are human beings. They'll have their ups and downs. When they are down, they need support. They don't require scolding. As a CEO, it is my job to ensure that I explain to Ashish Shanker why my fund has underperformed. And I'll give you a classical example. There was a particular IT company which my research analyst researched in 2017 and came to conclusion that it is not worthy of investment. It became part of mid-cap index at 1% weight, went up to 4% weight, and our funds underperformed whole of 2017 because of that. At every IC meeting, we were raising doubt that why are we not investing in this IT company which is doing so well? And every time our analyst came back saying that, no, sir, I don't like A, B, and C. We doubted our analyst and supported him through some field research conducted by our sales team across India. And fortunately, they also arrived at the same conclusion which my analyst sitting in Bombay was saying. We remained underinvested that company throughout 2017. And finally, 2018, bubble busted and the company is out of index. Now, this is what is the fund managers need. If he has taken a right call, even if it's going wrong in the short term, as CEO, we have to support him. As CEO, it is my job to reach to my investors, my distributors, my partners, and tell them what we are doing and convince them that what we are doing is right. This gives tremendous space to fund managers to do right thing. And as someone mentioned, investment is not about doing right things. It's all about avoiding doing wrong things. So my job is to ensure that my fund managers do less of wrong things as they are at peace mentally to take short-term underperformance. In equity, our strategy is very simple. People give us money because we are professional. I should not make the same mistake which they are capable of making on their own. Today, Z Group shares are delivering 100%, 200%, 1700% return. Am I supposed to repeat the same mistake for short-term gain? Answer is no. Our philosophy is buy good company, run by good managers at good price. What do I mean by good company? A company whose business is real and whose return on equity over a cycle will be more than cost of capital.
Right.
Gone are the days when we invested in business which was generating 8% return and paying 10% cost of capital. I want to do opposite. Let my business earn 10% and pay 8% cost of capital. Good managers, I mean, in the olden days when newspaper used to come home, I used to always start with page 3, Bombay Times. And my wife and my daughter will always question that, Papa, read Economic Times, leave Bombay Times for us. And I said, no, I want to see on page 3 how many businessmen have appeared, because those companies I can avoid to invest. And trust me, by avoiding businessmen coming on page 3 in Bombay Times, I have saved far more money. We want to invest in managers who are young, who are working hard, who are committed to their business, who are not going to cheat minority shareholders. Finally, good price. I mean, everyone wants to buy at good prices, but market is not that kind that because Kotak Mutual Fund wants to buy, it will come down and then it will go up. So how do I create my good price? Well, I have to invest in those companies whose growth going forward will be more than what is expected by the market. As long as I can identify that set of companies whose profitability growth will be higher than expected by the market, I have my margin of safety. So very simple, fundamental approach, buying good quality companies, good quality businesses, run by good managers and at good prices. If we make mistakes, and we do make mistakes, we are happy to cut our losses. If we hit a jackpot, we are happy to run our profits. Many of our investments are in our portfolio over the last 5-7 years. We haven't changed them. We gladfully take short-term underperformance for long-term outperformance. I'm not in the business of creating short-term gain for long-term pain. On the fixed income side, our philosophy is SLR, safety first, liquidity second, return third. Today, if you see across my portfolios, we have avoided many of credit risk which my peers are gladly accepting. It's not that they are going to default. It's just that the credit risk and the price which they are paying is unacceptable to us. We will wait for right opportunity. For me, return of my principal is more important than return on principal, return on investment. In fixed income, better to get 100 rupee of principal back rather than get 1 rupee of extra interest. Second, I run open-ended funds. I have to pay back my investors. So liquidity of portfolio is very critical. You can generate high return by buying illiquid stock, but then eventually you will be trapped on illiquidity. And finally, you have to generate return, no doubt about it, but you have to optimize risk-adjusted return. If I have to sum up my entire investment philosophy, we are in the business of optimizing risk-adjusted return. I have to take risk, but I have to manage it well. And post taking appropriate risk, I have to generate return.
Thank you, Nilesh bhai. I think that was a fantastic overview. To just dig a little deeper on the equity side, I mean, you have different managers like Harsha, you have Harish, and then you have Pankaj who manages mid and small cap funds. Uh, whilst I understand that the broad philosophy is to buy companies which generate high returns on the capital, run by good managers at reasonable valuation, how much leeway do you allow every manager? Because everyone will have his opinion, and how much is he allowed to express that opinion in the portfolio?
So undoubtedly, my job is to create boundary, and Harsha as CIO also creates boundary. Within those boundaries, everyone is free to paint their color or play the game as they want. But boundaries are completely cast in stone. For
Okay.
example, we don't want to invest with chore promoters. Now, this is not compromisable. If Harish, Pankaj, Harsha has a problem with that, they have to go and find another organization. But
Right.
the good part is that this boundary has been created by them only. It is their collective experience which has given them the wisdom that you don't make money with chore promoters on a long-term basis. The only downside in this is that when those chore company promoters shares starts performing, their funds will underperform. But we are fine with that. I'm happy to go and meet the world and explain why we are underperforming because we didn't invest in that chore company. Similarly, liquidity of portfolio is critical because we are running open-ended funds. Now, which fund manager would like to create an illiquid portfolio and come under the pressure of selling in desperation? So we build boundaries based on the collective wisdom of our investment team and then give them the flexibility. Each fund manager has the freedom to execute his thought process, but he has to operate within the boundaries of the institution. And this combination gives individual freedom within institutional framework.
Oh, great, Nilesh bhai. Moving on, you also don the industry hat as the AMFI chairman, right? We have seen days where income funds had entry loads, late 90s, and then we saw exit loads on equity funds. We've come a long way, right? From abolishment of entry loads to transparency of commissions around mutual funds, to we've seen this entire SIP boom over the last 5-6 years, and even retail investors behaving very, very sensibly. Uh, Donning your AMFI chairman hat, now the things have also got released for distributors yesterday night. How do you see this industry evolving? What is your advice for people like us? Given the context.
So one, there can't be any dispute on the overall objectives between SEBI, AMFI, and mutual fund distributors. We are all here for serving our investors. We have to do it with utmost governance, best transparency, and with genuine honesty. Will we always add value to our clients? Answer is no. There will be failures. But those failures will not be because we are corrupt, because we are taking shortcuts. Those failures will be because we made error in our judgments in all honesty. These objectives are cast in stone and we are all committed to it just like regulator. Have we achieved everything in order to achieve these objectives? Answer is no, it's a journey. We'll keep on improving as experience comes to us. Now, coming to the distribution fraternity, clearly there are two ways. One, mutual fund distribution, where you get commission from the manufacturer, and second, advisory, where you get paid by the investor. Now, SEBI has differentiated these two streams and allowed a corporate entity to pursue both at the group level. I think it is a very fair decision where if a customer to an organization is on an advisory basis, then there should not be any distribution to him. And if he's on a distribution basis, there should not be any non-incidental advisory to him. When a person is coming to buy mutual fund, of course, you will give advisory related to mutual fund. but you should not be then advising him on real estate and so on and so forth. I think India needs a very, very serious level of distribution. Today, there are many distributors who are into transaction business, who are not into advisory or relationship business. You have to migrate to a level where each family has a family lawyer, family doctor, family chartered accountant. Same way, they need to have family advisor, an advisor whom they can trust, an advisor who is professional, and an advisor who, whether he's a mutual fund distributor or registered investment advisor, is interested in protecting his client's interest. This professionalization of distribution community is extremely important in order to create a scale. If we want to grow this distribution business, it requires professionalization. It requires building up on the platform which has been built by the efforts of distribution community over the years. Unlike many other distribution businesses, mutual fund distribution business is one of the most transparent and least cost model. And we need to continue to build on this platform to take it to greater heights. Today, we are serving 2.25 crore unique investors in mutual funds. The potential is 25 crore unique investors. There is a tenfold growth in customers and probably AUM, which is possible if we gather our act together.
Right. No, interesting thoughts, Nilesh Bhai. And I personally believe that this could be a pretty revolutionary point in the distribution industry. Like you said, the size of opportunity is very large. And I just hope that the amount of due diligence that people put in to identify a health professional, because the impact on health is immediate, whether it's a damage or improvement. Unfortunately, if you do not get a sound advisor, the damage is known over time and it's very, very gradual. So I just hope that this is a turning point and more people turn to professional advice and are willing to pay for provided, of course, they ascertain that the value addition is there and all the other hygiene points such tick. So Nilesh bhai, thank you very much for that. Moving on to the last section, I wanted to also draw from your journey. I mean, you had a fantastic journey. I mean, from being a gold medalist in chartered accountancy, we worked together very briefly in an organization in the late 90s. You've had a fantastic journey. What have been your key learnings? I mean, if somebody is starting out today on the same journey, someone who's graduated or a CA and entering this industry, what are the 2-3 key learnings or advice that you would give to a
I mean, at my age, I think it is always important to work for bigger objective. When I was young, I wanted to be the best performing fund manager. Today, my objective is to enrich my clients, enrich my partners. It doesn't matter whether I'm top performing fund manager or not. When you migrate from lower objectives to higher objectives, somewhere, the universe unites to support you. Maybe it's spiritualism, philosophy, wisdom after health goes away or becomes white. But I think it's important to aim for a higher objective in order to get divine grace, divine support. Second, do what is right. Do what is right for your customers, not for your organization. Ashish, you will remember in 2003, our fixed income fund was more than 6,000 crore. Interest rates were at 5% on a 10-year gilt. For 7-8 years, we had delivered better return than equities and money was flowing in. Fortunately, not only me, but my entire band of fixed income fund managers across all institutions come together in warning customers to redeem from fixed income funds and move into floating rate funds, liquid funds, or equity funds. We tried actively to lower our AUM in fixed income funds. Today, media may have forgotten this sacrifice, this unique history in the entire mutual fund industry's record in world. But investors and clients have remembered. They knew we worked for them, not for our organization alone. And that goodwill has helped us to reach where we are today. There was short-term pain in taking that decision, bringing your 6,000 crore fund to 200 crore over a period of time, but it was the right thing to do. And fortunately, all our organizations supported us wholeheartedly. Never even once my CEO complained that, Nilesh, what are you going and talking out in the market and telling investors to redeem? He encouraged us. We launched floating rate fund, which was India's first floating rate fund when there was no concept of floating rate instruments in India. My CEO had problem with that, saying that, Nilesh, how will you manage? And I said, sir, please allow me an opportunity. I will figure out how to manage. And he took chance with me. He took risk with me. What we did was right for our customers, and that is why we have reached here. Always take bigger objective. The whole universe will grace you for doing that. That's my one learning. Do what is right. Don't be afraid of short-term consequences. In the long term, divine grace will support you.
Right, right. No, absolutely. I think spot on and well said that strive for a higher purpose and things will fall in place. And second, like you said, do what is good, and do what is good. Nilesh bhai, someone told me that, in most situations, you instinctively know what is good. The moment you have to rationalize it, that means, you're walking a very, very tricky path, because instinctively the mind and the heart knows in any situation that this is the good path to tread. But then sometimes, we tend to rationalize it and do the. So, yeah. Nilesh bhai, any books that you would recommend? Because at Motilal Oswal, we value knowledge a lot and we try to bring insights and more richness and knowledge to our customers. Any 2-3 books that have influenced you and you would recommend to our clients or, new practitioners?
Instead of book, I will recommend a habit. Try to read at least few hours a day. If you're very busy, 1 hour a day. If you're very busy, half an hour a day. If you have more time due to lockdown, 3-4 hours a day. But try to spend some amount of time every day religiously with discipline in reading something. If you can read book, great. If you can go to Google and search a topic and enrich yourself, great. If you can, pick up thousands of email which clog your inbox every day, some of them, great. Try to make a habit of reading and acquiring knowledge part of your day-to-day life. That habit will be immensely rewarding.
Right.
In terms of reading, Ashish bhai, read anything. Everything comes handy. When I was a kid, I used to read Ramayana and Mahabharata. And many a times I was wondering, like, in finance, will this book ever help me? And today, touchwood, I think a lot of examples from Ramayana and Mahabharata are coming handy in explaining concepts of investments to the world. For example, when people say, Nilesh bhai, should I invest direct? Then I said, sure. But do you think you are like Eklavya? Eklavya could learn archery on his own by keeping Guru Dron's pratima or idol in front of him, because he was dedicated, he was disciplined, he was willing to acquire knowledge, skill. Do you have that kind of discipline? Go and be Eklavya. But if you don't have Eklavya's discipline, hard work, tenacity, then please follow Arjun model, which required Guru Dron to teach him archery. The talent of Eklavya and Arjun was the same, but the path was different. So even things like Ramayana and Mahabharata will come handy in understanding market. You can go to the ultimate, books on market. There are thousands and thousands of books which one should read, but this reading habit will be the most important thing. Otherwise, these books will come and it will just line up on your shelves. You don't want to impress outsiders by lining up your shelves. You have to enrich yourself by opening up those shelves and reading those books.
Yeah, well put, Nilesh bhai. I think more than trying to figure out what to read, inculcating the habit of reading itself is a big achievement, and then you'll find your path. Last English, I mean, the last 2-3 months has been pretty disruptive for a lot of us. We are one of the fortunate few to be sitting in good houses and conducting our work from home. But over the last 2-3 months, what are the big learnings, Nilesh bhai? Because whenever something like this happens, one tends to introspect. Uh, and learnings, I would say, at three broad levels. I mean, one is for the globe or humanity as a race. Second, India as a country, and personally, I mean, at your level, how has this changed your life, or any learnings that you would like to share?
So one, we have to really become appreciative of everyone else who is supporting you. Many a times in our busy life, running from one place to another place, we probably forgot to thank others who were supporting us, who were contributing to us. Uh, that office boy who provided you hot cup of tea, that cleaning person who kept your environment clean, that maid who worked in your house, their contribution was very, very important in your journey. And how many times you turned around to thank them. I think this lockdown has taught me art of appreciation. I have become more appreciative of people who have supported me, who are supporting me during this journey. Second, this lockdown has also bring the importance of self-discipline in front of you. People who are more disciplined in terms of their public-private hygiene, in terms of social distancing, they have done well during this crisis physically. People who took it for granted have paid the price. Like in investment, in real life also, discipline gives a very, very important contribution to the success. Third, while we have seen a lot of troubles because of this lockdown in various parts of the country, there are many positives which I have seen in our areas. My daughter loves feeding dog, and we were distributing dog food in and around our area. And it was so fascinating and heartening to see that we were not alone. There were so many people who were willing to, take care of stray dogs, even in the lockdowns. In our area, uh, there are many elderly people whose mates could not come, and they were facing problems of food. And it's a wonderful effort by people of this area, which started supplying food to all of them in the morning and evening and afternoon. And I can legitimately say with pride that it was such a wonderful effort where people kept on supporting each other. We have our MLA, Mr. Amit Satan, and on WhatsApp, I got a forward from an NRI who said how Amit Satan took care of her parents. I mean, these are all the positive stories which we don't hear. My wife works with Isha Foundation, and they were doing wonderful work. I mean, I was busy answering investors' webinar from morning to evening or late night, and she was working even harder than me. And the amount of support, contribution they were able to make through the efforts of all the well-meaning citizens, it may not be recognized in media. It may not be good enough to take out all the pains of the lockdown. But I think they were all candlelights in this darkness. While majority of us focused on the darkness, there were many candlelights which were burning to remove this darkness. And all of us should try to be a candlelight. If collectively all of us burn, I'm sure this darkness will be removed.
Right. No, fantastic, Nilesh bhai. I think it's been a outstanding conversation, very enriching for me, and I'm sure for all the people who are watching or eventually will watch this recording. And I know that I can go on with this conversation, but I guess we'll have end it here for now. But just to quickly summarize for the benefit of all the people watching, I think we had a very, very comprehensive conversation on global macros where you made the point that this time around, the central banks have far more resources than what they had during the Great Depression, because a lot of parallels are being drawn. Last time they had a gold standard and hence they couldn't do too much of stimulus. This time they have really been ahead of the curve. And you made that point of short-term gain versus possibly some pain in the longer term. So we have chosen the short-term gain part and pumped in a lot of liquidity at this point in time. You also made the larger point of productivity, growth, and population, where we saw the Japanese example where Japan didn't grow in spite of the stimulus. And one of the reasons is probably because they didn't allow migration. So they didn't see the increase in working age population. Unlike Japan, I think US has been very, very proactive, and they've allowed intellectual migration, and a lot of people have contributed to their growth. Similarly, India and China continue to have very favorable demographics. So it is very possible that our growth rates continue to be superior even in the future. And these large pools of capital will definitely value growth at a premium. So we will see a lot of we can see a lot of capital flowing into India. Second, you made the point about India being very asset rich and balance sheet being in good shape. You also made that point, and if I were to coin a term called economic racism, I think we face that compared to the Western countries, where they get rated much higher than us in spite of having worse off balance sheets. But the simple, so hence we have to tread more carefully. But the simple point is we have a lot of resources, and like you said rightly, that RBI has been a pinch hitter and has put in liquidity immediately and has been even a bit ahead of the curve, I would say, in this crisis. But the government has been a little more cautious because, like you rightly pointed out, I think the supply side bottlenecks have also to be eased. You can't just pump in demand. Both have to go parallelly. And like you said, we have a lot of resources as a country. And you made a point to all the assets that we have, which can be unlocked. So definitely there is a lot that the government can do. And the growth rates can be much higher if we are able to successfully attract a lot of capital for manufacturing. I mean, we did that in IT, and you made a point that with more and more companies wanting to come to India, we can take advantage of that. And again, there, I think bad news travels faster than good news. You gave that very nice example of Vestas setting up in India in record time. And I'm sure we'll have many, many more examples in the future as well. So I think we can do with a lot of optimism on that front. And you very nicely explained, Nilesh Bhai, on the industry side, on asset class side, that overweight equity, a bit overweight gold, and also some of the credit issues that we have seen is behind us. And still you made the larger point that, and I also kind of reiterated that having a diversified portfolio through mutual funds, you would have still waded through this entire period in a much better manner, because individually a lot of people who bought individual debt papers have seen much bigger drawdown. And again, you know, on your philosophy and framework, I think you gave a nice overview on how equity is managed and how fixed income is managed, and where you made the point of having boundaries, and then within those boundaries enough independence given to each fund manager. And I think a robust process and a rule-based philosophy, like you said, your job is to ensure you don't make the same mistake that individuals make as an institution, because we are professional fund managers, and liquidity being at the core of all your investment decisions. I think that was fantastic. And lastly, but not the least, you know, on the industry front, like you said, we have a huge growth path ahead of us. But I think both of us, whether it's the mutual fund industry or the investment distribution or the advisory professionals, have to be responsible enough to be able to be transparent and guide investors towards the right direction. And the last part really, you know, I've learned something from you, Nilesh Bhai, again today, that this entire period of crisis has really taught us to be appreciative of all the people around, and really the way humanity and people around us have risen to the occasion. A lot of these stories, like you said, don't get talked about. And, you know, our media channels or social media platforms are flooded with a lot of negativity. I think we can do with a lot of positivity in these periods. And you made a very nice analogy that we can all become a candlelight in this darkness. And if we do that, I think the world will be a brighter place. So on that note, positive note, Nilesh bhai, thank you very much. It was a fantastic conversation. Thank you very much. You're on mute, Nilesh bhai.
Sorry.
Yeah, thank you very
Thanks, Ashish. All the very best. Stay safe, stay healthy, and stay invested.
Yeah, we continue to wish you good health, and like you rightly said, serve a higher purpose, which you have been doing. So thank you very much and all the best.
Thank you.